Investing can feel, well, just so complex, right? It often seems like a game that's rigged for the insiders. But what if I told you the real path to building wealth was actually simple? So simple, in fact, that it's been proven to work for over 50 years. Today, we're going to dive into the absolutely timeless lessons of Burton Malkiel.
Okay, so this is the quote that pretty much started a revolution. When Princeton economist Burton Malkiel first wrote this back in 1973, you can imagine the entire Wall Street establishment was not happy. A monkey could do their job? I mean, it sounds totally absurd.
But that's the big question we're going to tackle today. What if he was right? What if decades of hard, cold data actually prove this shocking statement is, for the most part, true? Well, we're about to find out. So to get there, we first have to understand the core problem that nearly every single investor, big or small, runs into. It's called the investor's dilemma.
All right, check out this data. A study by a group called Dalbar found something absolutely stunning. Over a 20-year period, the stock market itself, the S&P 500, which is basically just the 500 biggest US companies, went up about 11.6% a year. But the average person investing in that market, they only got 4.5%. I mean, that is a huge gap. What on earth is going on here?
Well, the hard truth is we're pretty much our own worst enemies. When the market is soaring and everyone's feeling great, that's when we get FOMO and pile in. We buy high. And when the market tanks and the headlines are all doom and gloom, we panic and sell everything, locking in our losses right at the bottom. Our emotions just consistently trick us into doing the exact opposite of what we should. Okay, so if our own gut instincts are the problem, what's the answer? For that, we turn to Malkiel's incredible work, A Random Walk Down Wall Street, which really laid the foundation for a completely new way of thinking about all this. At the very heart of his book is this thing called the random walk theory. And the idea is pretty simple. Stock price movements are basically random and unpredictable. Why? Because the market is just so incredibly efficient. You've got millions of super smart people out there looking for any little edge, and the second any new information pops up, it gets priced into a stock almost instantly. Malkiel has this fantastic story to make this point crystal clear. An efficient market professor is walking with a student, and the student spots a $100 bill on the ground. As the student goes to pick it up, the professor just says, "Don't bother." If it were a real $100 bill, someone would have already picked it up. In the stock market, those easy $100 bills, those obvious great deals, they just don't sit around waiting for you. So, Malkiel says investors are basically caught in a tug of war between two big ideas. The firm foundation theory says stocks have a real concrete value. But the castles in the air theory, it says a stock is only worth whatever someone else is willing to pay for it. This is what explains crazy market bubbles, like the dot-com era, when people were paying insane prices for stocks with zero profits, all because they hoped to sell it to a greater fool later on. All right, so if the market's a random walk and our emotions just get in the way, what are we supposed to do? Well, Malkiel's theory leads to a beautifully simple set of rules that are designed to solve this exact problem. Here's the action plan. It really just boils down to three simple, powerful rules. First, stop trying to outsmart the market. Second, automate your success. And third, you win by not losing. Let's break down exactly what that means. Rule number one, and this is a big one, just stop trying to time the market. Malkiel is super clear about this. He says he's never met anyone who can do it consistently. And here's why it's so hard. You have to be right twice. You have to know when to sell, and you have to know the perfect time to get back in. And get this, the market's best days often happen right after the very worst days. The data shows if you miss just the 10 best days over a 15-year stretch, your returns basically get wiped out. Now for the second rule, let's try a little thought experiment from Warren Buffett. He asks, if you're going to eat hamburgers for the rest of your life, do you want the price of hamburgers to go up or down? Of course you want them to be cheaper, right? So, if you're a lifelong investor, why do we freak out when stock prices go on sale? We should be excited. And that idea leads us right to the core of rule number two. Automate your success. By investing the same amount of money on a regular schedule, that's a strategy called dollar cost averaging, you automatically buy more shares when prices are low and fewer when they're high. You pair that with rebalancing once a year, where you sell some of your winners and buy more of your losers. These two simple automated systems take your emotions completely out of the equation. And that brings us to the final rule. Rule number three, win by not losing. Malkiel found that the single best predictor of how a fund will do in the future isn't some star manager or its amazing past returns. Nope, it's how much it costs. In one study, the funds with the lowest fees outperformed the funds with highest fees by a full 2 percentage points every single year. As the legendary founder of Vanguard, Jack Bogle, used to say, in investing, you get what you don't pay for. Okay, the rules sound simple, right? Maybe. Too simple. But does this stuff actually work in the real world, especially when things get ugly? Let's look at the proof. Yeah, this slide really lays it all out, doesn't it? It's like two totally different ways of thinking. On the left, you have Malkiel's principles: humility, accepting you can't beat the market, and investing for the long term. On the right, you have what most people do: overconfidence, trying to pick the next Tesla, and trading all the time based on the daily news. One is a calm, disciplined strategy. The other is a recipe for making emotional mistakes. All right, let's put this strategy through the ultimate stress test. The decade from 2000 to 2010 is often called the lost decade. It started with the dot-com bubble bursting and ended with the global financial crisis. It was brutal. If you had just put your money into an S&P 500 fund at the beginning and held on, you actually would have lost money over those 10 years. But get this, an investor who followed Malkiel's rules, who diversified, rebalanced just once a year, and kept adding money, would have turned $100,000 into roughly $250,000 during that exact same lost decade. How is that even possible? Well, the system turns scary volatility into your best friend. By buying consistently, you were scooping up tons of shares when prices were at rock bottom, which paid off like crazy when things recovered. And look, it's not just regular folks like us who struggle with this. The data is just overwhelming. Over pretty much any long period you look at, something like 75 to 90% of professional, highly paid fund managers fail to beat a simple, cheap index fund. It turns out they can't beat the blindfolded monkey either. So after all that data, all that theory, what's the one big idea you absolutely need to walk away with? It all comes down to Malkiel's most famous and frankly brilliant analogy. He says trying to find the one stock that's going to beat the market is like looking for a needle in a haystack. So his advice? Stop driving yourself crazy looking for the needle. Just buy the whole haystack. And you do that with a simple, low-cost index fund. And really, that's the whole ballgame. The logic is simple, the data is undeniable, and the result had been proven for over half a century. You know, the hardest part isn't understanding this strategy. It's having the discipline to just stick with it through thick and thin. So the final question is really for you. Are you ready to stop searching for needles and just buy the haystack?